guys, welcome to CA Inter Financial Management MCQs. I'm CNO Jalota. Everything has a logic. If you know that logic, there is no need to mug up. That is whatever our entire teaching has always been all about. No formulas, no nothing, pure common sense, only through concepts, nothing else. Let's start off the question for today. We are doing a chapter called as working capital, and it's important to manage your working capital. If you have less amount of working capital, then short-term solvency becomes a very big problem. Every day you will face a problem of money. But then if you do have excess amount of working capital, your profitability will be quite less, because otherwise this money could have been used for acquiring fixed assets, and fixed assets always give a greater return as compared to current assets. So therefore, managing working capital is super important in real life. That's what we try to be learning in this entire chapter. Let's start off the question for today. Just before I start, please do remember every Saturday, Sunday, we are coming out with our lectures of CA Intercosting, complete lectures of our previous batch. This includes everything that a student can be asking for, including summary of every question, ranking of every question, dedicated kind of a homework section, test series, and every new RTP as well as the papers the day they are done. We are always the first one to be releasing complete solution, not discussing, trying to launch the complete solution on the day of the examination. Do check up all our videos, match them with the dates, you'll start to be realizing. Let's start it off. For today, the question is, under the hedging approach to financing of working capital requirements of a firm, each asset in the balance sheet asset side would be offset by financing instrument of the same approximate validity. This statement is, bring me the four options, incorrect, okay, correct, okay, partially correct, cannot be saying. Now this is a tough question. In case if you know the answer, brilliant, try that. Now see, understand first of all that what do you mean by hedging approach, okay? But before that, when we did this entire chapter, okay, we made some inherent assumptions for the liability side. We made some assumptions about the asset side also, like fixed assets give greater return as compared to current assets. That was one assumption that we all made, okay, which is logically true also in real life, because due to fixed assets only you produce the goods, you sell the goods, so therefore profitability is because of fixed assets, okay. But for liability side, in this case, we all made some assumptions. Long-term funds always have higher cost as compared to short-term funds. Then why to use long-term funds? Because the risk over here is lower, because immediately you don't have to be repaying them. Second one, obviously the opposite of this, short-term funds or current liabilities like say creditors, outstanding wages, they don't have any cost, okay. Might be in case of bank OD or cash credits, you might have some cost. So overall short-term funds have lower cost, so therefore you should always be taking them, but then risk over there is higher, okay. These are two assumptions that you all should keep in mind whenever you are trying to study this entire part. Now as far as working capital goes, see, working capital is current assets minus current liabilities. Part of current assets get financed by current liabilities. Keep that thing in mind. Part of current assets get financed by current liabilities. Whatever part of current assets does not get financed by current liabilities will automatically get financed by long-term funds. In case you do not understand, let's start to be talking of this thing. This approach is going to be called as hedging approach. It tells us how much short-term funds are to be used, how much long-term funds are to be used. Hedging approach. Now, hedging is a word which is used in stock markets a lot. Okay, hedging is basically taking an insurance. Okay, those people who do understand stock market, one line for them. Suppose you try to be thinking some stock will be rising. Okay, so therefore you buy the shares of them, okay, or you buy the futures of them, okay. We call that as a long option, okay, buying and then trying to sell whenever the prices will rise. But then you cannot be dead sure in stock market it will happen, so therefore to hedge yourself you try to take a put of those shares, okay. So this was only for those people who know about the stock markets, okay. Now hedging approach for working capital means what? It means that current assets get financed by similar instrument on the liability side. Now, what does this thing mean? I'll try to demonstrate through the balance sheet, but then do remember, hedging approach is a most risky approach. There are some other approaches like a conservative approach, moderate approach, and so on, but this is a most risky approach. Okay. Now, risky approach will always be giving you all highest profits. Okay. But then over here, the risk is also the highest. Okay. Now, try to think this is the balance sheet. On asset side, you have your fixed assets. Not much concerned about that because I'm concerned about working capital. Working capital is current assets minus current liabilities. Okay. So here are your current assets. Now, current assets have to be financed. Everything on the asset side get financed by the liability side, correct? So on liability side, you will have your long-term funds as well as your short-term funds. Short-term funds are also called as, in this case, current liabilities. So please do remember, current assets get financed by long-term funds and by short-term funds. Long-term funds have higher cost. Short-term funds have lower cost. Okay. Now, in this case, try to be thinking something like this. If you use more amount of long-term funds, your cost will be higher based upon those assumptions that I told you. So profitability will be lower. If you use lot amount of short-term funds, then in that case, your profitability will be higher. Okay, because the cost over here is lower, but then risk will also be higher. Okay. What does hedging approach say? Hedging approach says try to be using short-term funds to maximum extent. And to what extent? I'm trying to explain exactly those words. Suppose one of the current assets is nothing but stock. Okay. Stock is your current asset. Suppose in this case, your stock turnover ratio in days, is nothing but say 60 days. We call that thing as an inventory cycle. Okay. It is say 60 days. Now try to be thinking stock has to be getting financed also. Okay. You want to buy stock, you don't have money. Okay. So therefore, you can get it financed say by creditors. Okay. Say to creditors also, we have to pay exactly after 60 days. Okay. So therefore, the creditor cycle is also 60 days only. So try to be thinking stock entirely gets financed by creditors. We would like to do this particular thing as much as possible. Everything on asset side, okay, should be matching with the liability side. The cycle over here should be matching with the cycle over here. That is nothing but in this case going to be called as a hedging approach. In hedging approach, now we try to be saying most amount of current assets should get funded by the current liabilities only. Like stock should be funded by creditors. If it cannot be exactly done, then you try to be using long-term funds as such. Okay, so I gave you all one example. Okay, so for hedging approach, this is whatever we all try to be saying also here. Current assets are majorly financed by the short-term funds and the long-term funds are not used much often, so are used very less. Okay. So therefore, majorly your current assets will be getting financed by the current liabilities or short-term funds. Try to be thinking you are using short-term funds very high. If you are using short-term funds very high, cost of short-term funds is lower. Okay. If it is lower, profitability will be higher. But profitability is higher, the risk will also be higher here. Why? Because short-term funds can be demanded at any moment of time. Creditors can ask for their payment at any moment of time. Okay. This is nothing but hedging approach. Okay. Now, just before in this case, I try to be revealing the final answer. You have something called as a conservative approach also. Conservative approach, current assets will majorly get funded in that case. In case of conservative approach, okay, majorly in that case by long-term funds and short-term funds are seldom used, okay. But let's come back to the question. The question is this: under the hedging approach to financing of the working capital requirements of the firm, each asset in the balance sheet side would be offset with a financing instrument of approximately the same maturity. This statement is absolutely correct. This is the funda about hedging approach. In fact, in your textbook also, we have written exactly the same words only. Exactly the same words. Okay. So answer over here should be B. That should be the correct answer. That is the correct answer. That's it from my side for today. Our aim is to be giving you all best of the logics. Please ensure that you have the logic of everything. In case still sometimes the things are not clear through our videos, you can always put a comment below and we'll try to explain you all again through might be some better ways. Okay, that's it from my side. I'll see you all next time. Till then, happy learning. Bye.